Itiviti. I'm delighted to be part of this first virtual Fix EMEA conference. And the next panel is on a topic that I'm really passionate about, cross-asset versus multi-asset trading, an important topic for the industry. Here at Itiviti, we've been finding there's been an increasing demand for our multi-asset trading platform to provide greater flexibility, improve workflow, and make it easier to support the data capture needs of regulation. During my 20+ years in the industry, at some point I've worked in every asset class. The problem of multi-asset is not a new one, but as the markets have become more efficient through electronification, the needs have evolved. If you take automation engines like the one we have at Itiviti, they need to be flexible enough to support the trading of equivalent or substitute products in their pricing, hedging, and trading algorithms. COVID-19 has further caused firms to reevaluate their workflows. Who would have thought 6 months ago that traders would be sat in offices like this trying to continue their day-to-day roles? And what it did was force firms to think about removing further manual steps from their workflows, driving more electronification and a further need for multi-asset solutions. The industry, though, is grappling with two very distinct challenges: the desire to be able to have a single platform where they can view and trade the different asset classes, organize their teams in different structures, whilst maintaining a common platform for meeting regulatory needs, versus the need to be able to trade and support workflows that inherently span different asset classes, such as pairs trading, ETF trading, or exchange for physical, for example. I must admit, though, in my 20 years, I've always used the terms cross-asset and multi-asset interchangeably. And in reaching out to my network, I found I'm not alone in this. So I'm really looking forward to listening to our panel of experts and clarifying the nomenclature. I will now hand over the virtual baton to Duncan Higgins to introduce you to our panel today.
Thanks for the introduction, Linda. Good morning, everyone. Before we kick off, I'd just like to remind the audience that all the discussions are taking place under Chatham House rule, and quotes from any of the panelists need to be confirmed prior to using in any form of publication. I'd also like to let you know that any polling that we do here will be via Zoom, so you won't have a need to go to your phone. And once you're finished with the panel here today, I'd encourage you all to go to the main platform to make use of the networking opportunities available. Visit the booths of the sponsors. I enjoyed catching up with a few people there earlier on. So with that, I'm just going to introduce our venerable panelists. We have Alexander McDonald, who's CEO of the European Ventures and Intermediaries Association. Chris Hollands, who's head of European Sales and Account Management at TradingScreen. Christoph Hock, head of multi-asset trading at Union Investment. Eric Heleine, head of trading at Groupama, and Paul Squires, head of dealing at Invesco. And that was all alphabetical order by first name, so everyone should be happy. So with that, I'd like to put our first question, and it's the question perhaps that Linda brought up in the video, and I'll put the question to Chris. So cross-asset, sort of multi-asset, she thought of them as interchangeable, and we've heard more about them in recent years, but what do you see as the difference between those terms?
Well, good morning, everybody. Yes, I think it's probably quite fair to say, as Linda has expressed, that there is often a kind of commonality or almost an interchangeability between the term multi-asset class trading and cross-asset class trading. However, I think there are distinctions which we can. Multi-asset trading really is simultaneously trading instruments from different asset classes. Maybe, for example, a basket of instruments which encompasses index futures with underlying equity names. Cross-asset class trading, however, is where there is a linkage or a contingency or a dependency between the different asset classes that are being traded. And as a consequence of that, the systems and also the execution downstream needs to be able to handle that. And there are also things like risk and exposure, which also have to be taken care of. And that, I think, is the main distinction between multi-asset versus cross-asset class trading.
Thanks, Chris. That's useful. So coming to you, Eric, how does Groupama organize its trading desks across asset classes?
Hi, everyone. The Groupama trading desk is setting up like a multi-asset trading desk. We have senior traders specialized on the different asset class supported by our investment decision. And the desk is running equities, ETF, fixed income product, listed and OTC derivatives, and FX. Operating like a multi-asset trading desk allow us to develop unified workflow and common nomenclature, meaning that we can use the same IT backbone is useful to leverage best practice and trading protocol already mature in other asset class. For example, fixed income portfolio trading have leveraged the knowledge of the fixed income equity tradings. But we would like to maintain the high-touch knowledge of the senior traders on each asset class to cover the whole product. We have started to develop some cross-asset approach because we have some contingency, like mentioned Chris in introduction. But it's quite new, and we need to work more deeply on these topics. Another role of the trading desk, and this role has been very important this year, is also to create smart content and analytics, dashboard, KPIs, etc., to help traders to navigate inside this market landscape. And this quantity of data available is a new area for typically for the trading desk to create bespoke KPI cluster profiling, something like that. And the cross-asset approach could be useful to work on it.
How do things compare to Invesco, Paul?
Morning, Duncan. Morning, all. So, yeah, very similar to Eric's description, certainly on the equities side. So I run the team that trades all instruments in EMEA markets. And those orders can come from investment fund managers from any part of the globe. So that's the kind of global and regional expertise that we have. They primarily trade cash equities across EMEA markets, but also trade some ETFs. And they'd also trade some listed futures when they're sort of attached to, a basket of stocks, because we have a dedicated derivatives trading team that equally is organized globally. So most of the sort of more complex derivatives would be absorbed by them. Separately and somewhat by contrast, I also manage the Henley fixed income dealing team. And they trade exclusively for a single investment team based in Henley, but that would be across all of the instruments that that investment team are responsible for. So that might be, cash bonds, whether it's high yield, investment grade, EM, but also they do some cash management and would arrange some of the daily FX trades that then get passed on to our dedicated FX traders. So a slightly different style of organization for that particular team.
Interesting, thank you for that. So we'll now try to bring up our first polling question. The question is, what asset class does your desk trade? Now, when we say desk, if you're associated particularly with a desk within your organization, respond about that. So if you're in technology, talk about the area that you support or the primary area you support. So is that area a single class trading desk? Are they trading multiple products, or are they trading multiple classes, or everything? Let us know what you are trading. There we go. We got some answers coming back there. So turning to you, Christoph, how does the organization at Invesco, at Groupama, but also the feedback from the poll, how does that compare with your experience? How's your desk structured? And perhaps think about the firms that service you as well.
Yeah, many thanks, Duncan. So looking at my peers represented here and also the results, I think it's not really a big surprise to see that multi-asset trading desk is a key topic for literally all the asset managers here. And that's exactly the way we are also structured at Union Investment. So when I started here about 6 years ago, we've had two completely separate trading desks, one responsible for equities and derivatives, the other one with responsibility for fixed income and FX transactions. And in a first step, what we did, we merged these two units to a multi-asset trading desk, but still with a key focus on the individual asset classes. So what we trade here at Union Investment is on the one hand cash equities, fixed income, but also FX and derivatives, and sec lending is also a key part of our business. business unit. So not to say that we were for the last couple of years siloed, but there was still a key focus on the individual asset classes, but we already started a high level of communication between the asset classes. And that's, from my perspective, a key topic, that communication between the asset classes has to function. So taking as an example the COVID-19 crisis, it was highly essential when discussing the situation around liquidity that you've had a look at what's going on in the credit space. Markets still functional, or do we talk about dysfunctionality because of potential illiquidity? This had effects on peripheral bonds and emerging market bonds, but also small mid-caps from the less liquid situation where affected. So therefore, from my perspective, it's essential on the one hand to have really the understanding what's going on, not only narrowly minded in one asset class, but literally in the market as a whole. And that's also looking at our role here at Union Investment. On the one hand, execution is key part of our business, but also delivering market intelligence to our portfolio managers. It's essential that you have a broader look, a broader coverage, and then not only, as mentioned, a narrow one based on observations in one asset class. And that's literally why most recently we went to a new organizational setup. So what we want to keep is, on the one hand, the KPI knowledge, in-depth knowledge in an individual asset class, but on the other hand, it's also of a big importance to have a dedicated look at high-touch trading, where that's one group we have set up as a part of our organizational structure, where all the business in complex, large orders with potentially a decent market impact are managed. That's across asset classes. And in the other group, we have a focus on technology. So these are on top of the KPI asset class knowledge, the other two key influencing factors: liquidity situation, high touch, and technology. And this group is called electronic solutions and technology, where all automation topics are discussed, where we define the filters for automation in the individual asset classes. Also, looking forward, I'm a strong believer that tokenization of assets will be a key strategic visionary topic for the coming years. This will be centered in this electronic solutions and technology unit. What's also important, that's the third part of our business, is a kind of, so to say, middle office, which is the link to the broker firms, which is in the link to portfolio managers, to traders, to our internal back office when it comes to KYC requests from individual broker firms, and they are answered by this team. So that's within the trading desk, a unit we have where no trading activity is executed, but it's from our understanding highly important to have also such a unit as a part of our business. And that's in the way we are structured now, and now we have to live it in practice.
Very good. Thank you, Christoph. So coming to you, Alex, you heard a bit from the three buy-side firms here. So how does their structure kind of match up to how your members are reorganizing themselves, I think, as trading venues? And then for the specialists, are they, the broking desks, are they becoming generalists across asset class?
Morning, Duncan. Morning, all. And the answer is, to an extent, yes. As somebody representing the trading venues and intermediaries operating these now familiar MTF, OTF, CEFs, RMOs in Asia, and trying to put that same liquidity pool around the world without too many breaks as the regs and the reporting changes. The process of the last few years has been to create a process where the reference data and the transactional data can work with the various regulations onto a venue domain. And that has meant that we've understood that a lot of the liquidity in wholesale markets comes from packages and spreads, and the underlying instruments tend to trade far less than the liquidity as it comes in as the way it's presented from either the buy side or through the buy side to the dealer community in the way they want to trade. So the challenge has been to create liquidity and the offering of liquidity in the underlying price factors of spreads and so forth that dominate the asset classes between derivatives and cash, between equities and their derivatives and the hedge factor and the underlying, or the options and so forth within it. And that has been, I guess, one of the big changes of moving what were traditional broking desks into the venue space by being able to electronically create what was a voice business in the package or the multi-asset end into a hybrid venue aligned technology, pushing out streaming prices or streaming IOIs for the underlying pricing curve so that there can be direct feedback with the clients. On the second leg, most of our members are also moving towards creating direct electronic interfaces at the multi-asset phase, whether that's a venue such as Fenix with BGC or COEX with TPI Cap or TradX and so on. There is also a much more of a multi-asset access portal to what were hitherto very specialist into dealer brokers in the old world.
Wow, sounds like they've been busy over there. Chris, Hollands, turning to you, bringing you into that. How do you see the sell side changing what they're doing? Are they adapting to the sort of multi-asset, cross-asset challenge?
Yeah, I think it's kind of been driven by the buy side, but also probably by economics. In the last probably 5-6 years, bulge bracket firms have often been merging together teams from separate equities and listed derivative teams to provide a common team. I think it's similar also in the OTC world. You've seen some coming together in the foreign exchange and fixed income worlds, sharing some technologies where market structure allows it. Then also on the technology side, there's also been some crossover or aggregation, if you like, partly to facilitate cross-asset class execution. So ability, for example, for algo engines to execute equities versus index futures. And in some cases back in time, there were geographical challenges in terms of latency. Getting algo servers in the United States to talk dynamically to algo servers in Europe has been a challenge. And that's been something the sell side has been making investments in to facilitate.
Very good. Okay, so we've actually got a question coming in from the audience, and I think we're keen to take those as we go through. So, question coming in from David Pearson. We've been working hard in the fixed post-trade space to expand the standards across all asset classes. Is the buy side increasing their scrutiny of the efficiency of their brokers' post-trade processes beyond just equity and government bonds in their broker reviews? The post-trade processes of your brokers outside of the sort of cash asset classes?
For Groupama, the post-trade is critical topics on the broker review. The operation team has 30% of the global overall notes of the brokers, meaning that we take into consideration that the settlement is totally involved in the process of the best execution. And that's true that we're trying to discuss closely with our sell side counterparty to be sure that they have put in place all the things to facilitate the matching and the matching process. We need still work maybe more with them about fixed connectivity and the fixed capacities about the post trade, but it's a very high topics for us for sure.
Very good. And Christoph, you were going to add something.
Yeah, also would like to take this, share our thoughts. So at the end, when looking at the whole process chain as at the whole workflow, it starts with order entry from the portfolio manager, then it's us within the execution team delivering best-in-class execution to our investors, but also, as Eric was stating, clearing settlement is an integral part of this one chain, and that's why, from our understanding, it's also important, despite that the back office is located in a separate unit, that we have a very strong connect to this team. And looking at again bringing COVID-19 as an example, we realized that a number of broker firms, not only in the DVP in the cash space, but also in derivatives, in listed and in OTC derivatives, they've had massive problems with the clearing of these transactions. And one might remember when a couple of days ahead of the quadruple witch in March, we've been somewhere at the peak of the COVID crisis. And we've had examples where broker firms they couldn't clear derivatives we traded, which were due to expire in March, so in a couple of days. And there was a big risk when having had not the clearing for these products that they go into a cash settlement, and that's why, from our understanding, it's key that the front office has a kind of escalation role when it comes to the communication to the various broker firms. It's a pity to say, but we experience fairly often when our back office is complaining with broker firms about settlement of trades, there's very little response. And when you, as a head of trading, with an escalation mechanism of a penalty box for a week or for 2 weeks' time, out of a sudden there comes movement into this process, and trades they out of a sudden settle immediately. And that's why we believe it's important. Settlement clearing is a key part of best execution, that also as a front office we have a dedicated focus on that.
Great, thanks for that, Christoph. And so that sounds like, David Pearson, that's a resounding yes to your question across these two firms at least. Mr. Squires, coming back to you and to talk about Invesco, how do you sort of think about things from a multi-asset perspective? Have you got one sort of Uber system that everything is done through, or are you how do you have to organise yourselves?
Yeah, so there are 82 trading professionals in our sort of global trading organisation. So you can imagine, I'm not sure I'd use the word Uber, but certainly there's a very much a sort of top-down approach to the way, kind of the themes that underlie the way we all operate. And I guess, one aspect is the operational efficiency, harmonization of operational platforms where that's kind of feasible. Global governance, clearly there's an aspiration to be as consistent as possible across sort of global governance, whether that's regulation or whether it's around post-trade analysis, for example, the monitoring of execution performance. So absolutely, there's a sort of best practice across the, from the senior management looking down, and how regionally and by asset class that is split. So definitely there's a sort of multi-asset look at that. Of course, as you come down to sort of the more local organizational sort of setups, things can be a little bit different. So my Henley fixed income team does not kind of fit neatly into the global fixed income trading organization. It's a legacy situation. But that's the anomaly, really. With that many people on that scale, it very much sort of lends itself to having the asset class split and then the regional split as well. And then even, for example, both of my two trading teams, both the equity team and the fixed income team, for example, they have 5 traders in each. Both can trade any instrument that comes onto the desk. I think that's important, both in terms of the breadth of their knowledge, in terms of being able to understand how different instruments operate and influence each other. But actually on a day-to-day basis, you can imagine this is fairly representative. Although they don't have specific job titles, there's a quite a natural tendency for that expertise to kick in by instrument. So, for example, on the equity trading team, I have one particular trader who is probably more inclined to take orders in the EM markets, one who's more inclined to trade UK mid and small caps, etc. And even on the fixed income side, again, they can trade any instrument that comes in. But we hired a sell side high yield trader, so he has that sort of expertise. We have an investment grade trader who, equally is more likely to pick up those types of order. And then you'll have someone who likes trading the macro instruments. So, it just depends on which level you're looking at things. So we we definitely aspire for consistency and harmonization. But I think on the day-to-day, the expertise of knowing a smaller universe of instruments really benefits the sort of outcome.
Thank you. And do the systems, so do the systems that support those two desks, are they similar to each other? Are they operating in the same systems?
So that's a good point, actually. So starting off on the OMS, there's a harmonization. It's not, I can't say it's universally applied. There are some inconsistencies there across the sort of global organization, but for the most part, yes, we're moving towards a single OMS platform. But then the question about multi-asset versus cross-asset kicks in a little bit more in terms of the EMS. So, for example, we use EMS for equity trading and for FX trading, but EMS is, it'd be interesting to see if Chris has a view on this. I would say for the most part, EMSs haven't lent themselves to fixed income trading yet. So, So different applications, yeah.
So we will come to you, Chris. But first, Eric, what do you think are the main challenges that are preventing synergies within technology, within, say, data providers, within, sort of transaction cost analysis, the things you do day to day?
Agree that the challenges are mainly technologies for sure, and communication, and also education. Sometimes also for the portfolio management team also to explain that have some impact. I firmly believe that the role of the trading desk is become a solution and technology integrator in the next few years for managing the core business, but also market intelligence that mentioned by Christoph earlier. And we, in the reviewing process of our IT infrastructures, we need to take into consideration and support this kind of evolution, because we think that being an expert of trading practice will not enough now in the futures if your trading front end doesn't have the capacities to help the traders to navigate inside the complex market structures, and typically on the multi-asset. This is why I think the main challenge is interoperability of the different systems that we have: OMS, EMS, portfolio management, additional tools, and the connectivity is key and is a part of the success. This is the main challenge that we have. We have a lot of discussion internally and externally with our IT partners to be sure that you are doing the right technology choice, and also that the vendor has the capacity to help us in this way.
Okay, thank you. So Chris, are the technology providers sort of stepping up to work to fill these gaps, to create the synergies?
Yes, thank you. I think so. And Paul, I think you need to upgrade your EMS quickly. We definitely are seeing increasing appetite for EMS capabilities in the fixed income world. Without a question, it's been the last asset class, or the one that has taken the longest to come to the EMS landscape, because of the electronification of fixed income has only really come about in the last few years. There are challenges because obviously there are in many cases the requirement to go directly to the fixed income venue's GUI to actually negotiate the trade. But we are seeing increasingly the opening up of fixed income venues, and therefore the ability for EMS platforms to actually allow the trader to reach the execution process itself without the extra hop. So I think it's changing, and we're definitely seeing that, and certainly our platform has benefited from that situation, and it's been a significant source of growth and development for us. And then just more generally, with the multi-asset class requirement we're seeing, and I'll move away a little bit from the long-only segment to the hedge fund segment, especially the macro segment. There is a genuine demand there to execute on a cross-asset class basis, and also to support different workflows, not just staging in from an order management system, but potentially to connect via some kind of quantitative engine, and also facilitate day-to-day traders to point and click to do unsolicited trading. And here we're seeing automation as being a unifier. So if there is this desire to execute cross-asset class, if you can use automation logic to do that trading across the asset classes, it's a massive boon, and something that we have seen a huge amount of appetite for, along with the other benefits of a multi-asset class EMS, which are data aggregation, and that's no small undertaking, and of course execution aggregation.
Great, thanks Chris. And Alex, coming back to some of the sort of trade types you talked about earlier, you mentioned packages, portfolios, and some other sort of complex baskets. What do you see as the sort of key challenges that firms are having to overcome?
Yeah, and so by complex baskets, I really meant a growing world of total return swaps that are done on venue that perhaps mirror or are the flip side to the growing ETF type market for hedging off there. So and to touch on the question that came up, one of the issues about moving what were hitherto brokered bilateral trades onto venue and under venue rules is post-trade certainty, whether the whole trade or legs of the trade are sent to CCPs for clearing, in which case, if that's moving to a world of multiple CCPs, which might have different credit pricing within them or different members from the traded community who have access to different CCPs, how that routing is done, or in the cash market. And we saw with the recent discussion around the CSDR rules from ESMA around, particularly for us, that all of the cash market products are done as match principal, where therefore the venue, the broker has both legs, and current protocols would not foresee a break between those legs, but the CSDR did, which fed through to further issues, and hence that particular set of regulations has been kicked down the road for further scrutiny. Post-trade certainty for these more complex products, multi-asset class products, is a lot harder, where there are various settlement agents or venues that need to affirm these trades, and you need to be sure of that at the point of arranging the liquidity. Ditto, now the move to implementing both variation margin and initial margin in derivatives for non-cleared trades is again to say, if you're coming in with a complex product and this is being marketed to the other venue participants, can everybody who's engaging in that more complex arrangement where you're putting together different legs to build the basket, i.e. it's not counterparty A and counterparty B, but there are maybe many counterparties who are coming in to arrange that transaction, that they all have the ability to fulfill that post-trade margin arrangement outside of CCP or into certain CSD, as well as in the prior world, just perhaps into a single clearinghouse, i.e. everybody's got access to LCH or something similar. The second two areas, probably generally rules and tech. In terms of rules, putting these trades onto venue means that you have to have your venue rules that work and can identify the reference product. What is this total return swap? How do I identify it? How do I make it available to trading and list it and give it all of the ISIN data? How do I provide pre-trade transparency to that spread or that product? Or am I simply representing this as a package of the underlying and putting transparency as the underlying? And then the whole world of putting multi-asset spread trades into a venue that's operating across different rule-making regimes. And this is, we see it in Brexit, but to be honest, we had it before between MiFID and Dodd-Frank or MiFID and Singapore, is how can I then rebroadcast that now rather idiosyncratic total return swap or that set of options with their underlying hedges not only into the EU as well as in the UK or vice versa, or into Dodd-Frank as well as into the EU, to bring together the participants who want to trade out of their subsidiaries or their branches in certain domains, but trying to bring the liquidity of that screen product, which is my screen going into these different domains under these different regulatory venue rules, together as one. And so all of the rules that have come in attempt to fragment the liquidity, and the challenge has been to bring that together to a single, if you like, virtual pit or hybrid pit or electronic broking pit, to bring that together. And then just on the general tech and the market model function, again, a lot more push on streaming IOIs, a lot more push on streaming orders, and the aggregation, therefore, where venues will stream out these prices and the users will tend to take prices from different venues, because in the world of, particularly beyond cash equities, you have multiple venues offering the same sorts of products. So there's this interest in the venues to receive streaming IOIs, to form a market and broadcast that out in a way that the clients can take that and push that into their various trade management execution systems and downstream to execution systems and downstream further. So all of this information needs to be tagged and have identity. So that sort of trade certainty making these complex things into venue rules and the various tech challenges for modes of execution to put these into streaming auctions or to put these into streaming platforms. What's been the focus of the world, probably up to middle of February until the focus actually moved away from product central to how you do it remotely central. I'll leave it there.
Wow. That sounds like a busy time has been had in that space. I think just thinking back and thinking through 2018, and I was worried about dealing with the volume caps and what have you on dark pool trading for equities. And I think reflecting on what you've just been talking about, I think we had it easy at the time. So we're going to bring up our second polling question now, and perhaps if we leave it up a little bit longer and give people opportunity to one, complete it, and then for us to be able to see the results of it as well. And I'm going to talk to Christoph while that's happening. So Christoph, earlier on, Chris Hollands talked about the difference between multi-asset and cross-asset trading. In which of those two forms do you see the greater benefit of bringing asset classes together?
The easy answer, Duncan, is you need to be able to deliver both to your portfolio managers as your clients. So on the one hand, cross-asset is an important topic when it comes to switch transactions. So looking at the portfolio manager setup here in our firm, we have a unit which is focusing on equity portfolio management. We have a fixed income portfolio management. We have a multi-asset team and a separate team focusing dedicatedly on institutional clients. And as a trading desk, our role is clearly to deliver best-in-class service to all these units. And whenever we have what I mentioned earlier, these switch transactions where you have a 2 billion transaction, which is where cash is removed in a fixed income product and it's shifted into equities. That's clearly a transition we have to be able to manage at the trading desk. But also when looking at day-to-day business in the FX world, to take an example, when you trade spot, but your portfolio manager wants to have the position then afterwards as a future position, so where you have to get involved in EFP business, it's something we have to be able to deliver. So the clear answer on cross-asset trading is it's driven by the demand of the portfolio managers, and whenever there's demand, we have to assure that we are able to manage to deliver the service to the PMs. On the other hand, when it comes to multi-asset, there is a clear need from my perspective within the trading team to live this story. So whenever to give some additional examples, we work orders in Italian BTP futures on derivative exchanges. It's important for the cash fixed income trader also to be aware of these orders when he's currently executing cash BTPs in the market, or whenever you are involved in single names where you have bigger order in cash equities. It's essential to know for the derivative guy probably trading single stock futures in this name, or for the trader in OTC derivatives when he's involved in single name OTC. So there's a massive dependency of one asset class from the other, and communication is key. But as stated before, not only within the trading team, but given the market intelligence function where we deliver observations to our portfolio managers about flows, positioning, about market color, market talk, volatility observations. That's important not to live the multi-asset story just within trading, but also to deliver it into the portfolio manager units. So as said, all in all, both kind of exercises, multi-asset and cross-asset, are really important.
Okay, thank you. Thanks. And now just turning to Paul and then to Eric. How does that those numbers on screen, how do they compare to your experience? 63% I added up, more than 10% of their trading is cross-asset.
Yeah, it's interesting. It's 10 to 50% is the sort of most common answer. We would be less than 10%. You know, I've talked about the equity traders trading ETFs. They'd also trade some listed futures and some convertible bonds, but it's marginal. So we would be less than 10%. But I think, you know, a couple of themes have come out from the discussion, right? One is, you know, to Christoph's point, trading desks are often organized to kind of represent the structure of the investment teams and the requirements of an investment team. So it depends on the asset management company really and what their mandates are. We, you know, the majority of our investment teams are dedicated to a single asset class. Sometimes have sub expertises, whether it's UK equities, European equities, for example. So I think that comes into it. And the smaller your buy side dealing desk, I think you are more likely to be cross asset. So I think those two themes play out. What I think is interesting, and again, it's something Christoph has spoken to, and I see that direction, you know, across asset class. I think everyone understands the growth of data and that lending itself to automation. And I guess, you know, you can, you know, in an ideal world, you have the efficiencies of automation for the sort of smaller orders, and you allow that therefore kind of greater bandwidth for your high touch or kind of fundamental traders to add their expertise. So I guess that's probably, you know, likely to increase the amount of cross asset trading that goes on as you go forward. That'd be my view.
Thank you. Now we are actually getting a little short on the time, so if we could bring up our final polling question for the audience, and then I'm gonna put a question to Alex while that's available for people to fill in. We are skipping a little bit, but in the needs of time, we need to do that. So Alex, you know, all of the firms here are very dependent on technology. What sort of initiatives have you been seeing that's changing trading for both on-venue and sort of OTC markets?
One of the big initiative areas across the trading venue IDBs has been to be able to mine the data better and get that out of what is going into market. So that was, if you had an electronic trading venue and a discrete instrument, then that was done, whatever, 20, 30 years ago. But for the world of the package, TRS, cross-asset markets, where the arrangements are really characterized as indications of interest rather than something formal that can be easily electronically presented, capturing that data, understanding what it is and being able to push that out to the market, and maybe not entirely through the existing quote vendor world, because the demand for the onward sell and buy side data usage has been to have authenticity to the pricing. So you want to know where it's come from. Is it coming from a regulated venue? Does it have a certain size? Does it have a certain post-trade execution capacity to it? Is all of this enriching of the data that people want when they're pushing it into various EMS or other trading venue systems down the line, or even the world of white labeling has come back as probably a bigger world than we had maybe supposed a year or two ago, has been to capture a lot more diverse data. You've seen partnerships with our member firms, AI firms, to put more artificial intelligence around this vast amount of data that's coming out, and to try and make more sense of that in terms of the cross-asset space and the pricing space between assets, and in the various other core economic terms of the values of correlations, the values of spreads between assets, and to push that data out to enrich the whole data set. So right. That's one of the main areas, but equally this idea of being able to get streaming prices into streaming auctions and to create multiple settlement points for very discrete instruments which are quite bespoke, but people are interested in trading maybe once a week, once a day, to have multiple rounds of streaming auctions for spreads and cross asset instruments as a whole, or portfolio trades as a whole, rather than breaking things down, has been another area where technology has probably been quite a game changer in the venue space.
Right. Thank you, Alex. Thank you. And so looking at those poll results, there's definitely a future further trend to increased multi-asset trading on there. For each of the panelists, if we have time, and starting with Chris Hollands, what changes are you looking to see that will support greater multi and cross-asset trading?
Yeah, I think in the OTC world, just the opening up of venue access, that's something we talked about a bit earlier. That's something which will be key. And I think also linked to what's also been discussed, greater use of automation, especially in the systematic hedge fund world, to concurrently execute across the asset classes.
Thank you. And what about for you, Eric? What are you looking for?
In Groupama, we have pretty aligned with the consensus of the pool, meaning that we need to improve the automated process and maybe to add in more additional skills in the team to arrive to manage the automated process in cross-asset approach. That for sure, but we would like to maintain the high-touch traders in the automated engine process to build decision tree because they have the strong knowledge of their activities and assets. The main topics is still technology and capacity to crunching the data to arrive of this process of automated. But for sure, this is the big challenge that we have for the next couple of years.
Right. And Christoph, you've already implemented that sort of future model that the majority of people talked about with a single automated desk, multi-asset. What changes are you looking for within your providers, technology, data to help that structure work most efficiently for the future?
As you mentioned, the key changes for the next 2 to 3 years we already made with focus on high touch and on the other hand on technology. And now it's already time about thinking what's then next from a very strategic visionary perspective. And topics I addressed earlier: tokenization of assets, getting potentially involved also in the crypto space. What are the use cases for blockchain within the whole process from execution to settlement, clearing within the back office we can make use of. I'm sure we will see massive changes, and in terms of technology, it's exponential growth we will see over the coming years, and it's important to lever it in a very best way.
Great, right. And last words from you, Paul, and then Alex.
So I think it's really interesting to actually just identify some of the changes to market structure over the last few years, and putting regulation aside. You've seen RFQ for single stock equities starting to emerge. I see more and more ETF trading taking place on a central limit order book. I think Alex's points around stream prices have always been interesting to me on fixed income. It's clearly central to sort of the way people have traded FX in recent years. So you kind of see a lot of those common themes spreading across asset class. I think it's going to be interesting to see where that kind of goes next, really. And I think we've already identified that there are some differences, fundamental differences between different instruments and asset classes, but the more you kind of pick out best practice from one asset class to another, I think that's probably where technology and innovation can really play its part.
Alex?
It's by trying to put these all-to-all, or these complex instruments, these spreads and other surfaces of how people want to transact into all-to-all markets, and into markets that are compliant to lots of different rules around instrument reference data and reporting, means you've got to have one standardization, a lot more, I think, use of tokens, and they might be DLT or other stable coin based tokens. We started to look at that for trade certainty even between the dealer market and CCPs some years ago, and I think that end of using tokens to be sure as trade certainty, as settlement certainty is going to increase. I think that the home working world of COVID has brought to us the dependency on the cloud, and I think that's from big tech to small tech to trading venues, the same, is things have got to go more into the cloud and be more dependent to allow that agility to be prevalent everywhere. And possibly, as I say, it was product led and market functionality led issues up to the start of this year, and now it's this resilience and cloud and remote agility, which is the lesson of the last few months and where the push has been. Yeah, I mean, I'll leave it there. I think it's the all-to-all market on difficult instruments.
Thank you. Interesting. So thank you, everyone on the panel. And all that remains is for me to say thank you to the audience for your attention. Hope you enjoyed it. And for the audience, if you can, in your virtual way, thank the panelists. But thanks to all of you today. And we'll see you in the networking zone.
I would just like to thank everybody for joining the session. And a recording of this session will be available next Thursday on the platform for 30 days after the event. And the next session in Stream 1 is going to be the evaluation of liquidity, performance, and service. And Stream 2, it'll be the introduction of FIX Next Gen and an introduction to the new generation of FIX implementation options. So please take a look at our sponsor booths in the virtual exhibit hall and network with the other attendees. And don't forget to join the live demos where you can find the agenda at the information desk. And we have a competition running for those who visit all the sponsor booths in the exhibit hall, and we'll have a prize. So thanks for joining this session and enjoy the rest of the day.